share that with your audience. So
Right.
I'm going to make a brief intro and then follow the questions, and then I'll do a quick closing. And I know you have time pressure, so we'll make this very concise.
Sure. Yeah, and I was just gonna mention too with that one question that it's it's not a specific answer, but I'll try to answer it as best I can.
No. We'll do general because our market is very
Sure.
depending on location. So I answered both of the questions that you had. So
Okay.
we were saying just go general. So let's go
Sure.
ahead and do it, Christy.
Okay.
Great.
We're recording, so I'm just going to hide myself, and you can
Okay.
take it from there.
Thank you. Welcome to the Financial Legacy Podcast. I am your host, Maria Ellis. I will bring you my perspective and the perspective of my guest on financial planning and financial legacy topics. Here at the Financial Legacy Podcast, we are changing lives one person at a time. To help you create and enjoy your financial success, connect with us at financiallegacy.live for your complimentary consultation. Today, at the request of our clients, both domestic and international, we will give you an update in reference to the Manhattan real estate market and its current challenges due to COVID. And of course, we're very pleased to welcome our very special guest, Noah Rosenblatt, founder and CEO of UrbanDigs in New York City. Noah, welcome to the show.
Thank you so much for having me.
Absolutely. Tell us a little bit about your company, UrbanDigs, and what inspired you to create it.
Sure. Well, UrbanDigs kind of was born out of the fact that there was no transparency in the New York City real estate markets. My background really is in trading and day trading and equities markets and kind of macroeconomics and that kind of stuff. I came from a trading career in my previous life to real estate. And when I looked at that market, I wanted to see the transparency that was available in the equity markets and the stock markets and the credit markets that we did not have for the real estate markets. So this is back in like 2005, 2006. And after about 5 years of transacting in New York City and learning the ropes and figuring out all the things that we need, I started UrbanDigs in 2010. So now it's 2021. It's been over a decade since we've been working on this project. And if I had to describe exactly what we do, we basically provide professional data and tools to the agents that ultimately service their consumers in the New York City markets, as well as provide data and insights on the markets. So charts, comps, CMA, and all the trends in New York City real estate.
And this is very important, not only for the agents to be educated about the current trends, but also for our clients to be able to make easier and better decisions as they look at an array of different properties that New York City has. So,
Right.
For instance, for people that are listening to us internationally, tell us a little bit about the various properties in the residential market, such as the co-ops, the condos, and the famous brownstones in New York City.
Yeah, I mean, New York City, just talk about Manhattan specifically for a moment, co-ops, condos, and townhouses pretty much makes up the bulk of the housing stock on the sales side. Co-ops, of course, will be the majority of those. Condos will be the second majority, and then townhouses will be just a minuscule number of transactions a year, maybe 3% or less, or 4% or less, or townhouse sales. So it's a very small market with low liquidity in that market. And 2020 was not a normal year, obviously, right? I don't need to
Right.
know that, but there was no seasonality involved in it. So the seasonal trends that we used to see with Manhattan real estate just went away in 2020, and we actually ended the year at our peak in terms of demand and activity for seasonality, which is very strange for our markets. But when I look at condos and I look at co-ops and I look at brownstones, they're all kind of doing their own thing. And the reason is because this down cycle has been very price point specific, right? As you probably know, the $2.5 to $3 million threshold is really defining two separate markets in this market, right? And if you're under that threshold, you're just seeing a whole different wave of dynamics. The listing discount for under $3 million is somewhere between 7 and 10% from original ask. That's a really good metric to look at in terms of like where the market is. Well, negotiability is about 7 to 10% right now. If you get over that 3 million threshold, you start to get into like 13 to 16%. And obviously the higher in price point you go, it starts to go higher, which means if you're looking at the brownstones in the townhouse market and you start to get into some 5, 10 million plus properties, the dynamics in that sector is much, much different than if I'm looking at studio co-ops, for example. So when I look at the co-ops in general, I would tell people that the market right now has rebounded from their COVID depths and the COVID lows where fear was high and liquidity was low. And that was pretty much defined by April, May, June, and July. The market has undergone a rebound, a recovery in terms of activity and in terms of price recovery. It's not like that market has rebounded all of its COVID losses, but at the end of the day, there wasn't substantial COVID losses in the co-op market. 3 million on the co-op market, again, you're looking at 7 to 8% is probably what the market was down. And if it's under 1 million in that sector, it's may even be down less than that. Since over the last 6 months, I think that market has bounced a few basis points in the positive way. Condos, different story. Condos, the listing discount's probably closer to 9 or 10%. Again, you get over that $3 million threshold. You start to think of new development condos, high-end condos. Those are going to be closer to 13 to 15%, right? So the overall meme here, the theme of this whole thing is that the market really didn't crash like you would expect during the 2009 financial crisis when the market kind of just fell off a cliff. We did have a sharp down move. It was bad for a while, but we did also have a notable recovery, and here we are.
Yeah, and I think that it took a lot of negotiation, right? I mean, a lot of give and take between the buyers and the sellers, because what I found out during 2020 is that there were a lot of investors, making half a dozen different offers on different similar properties, let's say a condo under $1 million for an investment for them to hold it and to rent it. But they put, half a dozen different bids out there. And since the properties were similar, whoever was most willing to negotiate, the seller, that's what they went with. So we as brokers, we're having a lot of fun, trying to manage and work with sellers and their expectations about it. So let's talk in general about, price per square footage that is currently taking place in New York. And I know New York City, as some of you are already familiar with it, they have different pockets. You have the Upper East Side, the Upper West Side, downtown, blah, blah. So we have different markets. But in general, what are you seeing in terms of price per square footage in condos, co-ops, individual homes? And also maybe we could talk about new developments, what's happening in that market.
Yeah, and the data is going to be all over the place, right? So for new developments, generally speaking, new developments is one of those sectors that got hard hit in this cycle. So let's just put the hard hit areas into a bucket, right? So you got new developments, you have anything in the higher price points, really, because the liquidity drained out of those sectors. So if you had to move property and you're in a 3, 4, 5 million plus price point, the liquidity there, the buy side demand just was not there. And of course, in those environments, sellers have to lower their price to move property, especially if there's a time to sell. So when I look at price per square foot, now you have to be careful. You have to be careful here because sales volume is down tremendously, right? And again, I know you're trying to, everyone wants to dissect, right? So we start out with the market and the condo market, then we go to the co-op market, then we go to the Upper East Side condo market. Now we're going to the 1-bedroom Upper East Side condo market. Now we're going to 1 to 2 million. So every time you slice
the co-op and the condo,
right.
So
well, I mean, everyone wants local. Everyone wants local, and that makes a lot of sense, and it's true. Every building in Manhattan is its own market, and 2 buildings right next to each other could trade vastly differently, even though they're exactly the same kind of buildings. There's so many differences between those 2 buildings. So again,
the amenities. Tell us a little bit about all the amenities in New York City that maybe some of our international clients might not be aware of it.
Well, when you talk about full service doorman buildings and you're talking about a concierge and you're talking about having a rooftop terrace and you're talking about having a spa in the building and all these different, a courtyard, basketball hoops, a swimming pool. I mean, some buildings have the works,
And that affects the price, obviously.
Yeah, but now you could go even farther, right? So now every building on a local level, if you want to just educate some new people to this market, right? Let's break it down this way, right? The views are different from building to building. Building A, building B, they're both right next to each other. They're both 30 floors high. They're both built in 1982. They both have full service doorman. What's different is the views, the configurations, the layouts of the building, the service level of the building, the facade, the look of the building, the construction of the building, the quality of the building, the amenities in the building, the financials in the building. What's my maintenance cost? Every building operates as its own business. Right. And some buildings make the right decisions and some buildings make the wrong decisions, and et cetera, et cetera. So all of these, intangible things that we can't kind of, we see it, but we can't kind of make any adjustments for the differences exist between building A and building B. And that goes into why one trades at 1,800 a square foot and one trades at 1,350 a square foot, right? And if you go outside of a building, most people are just kind of ignoring all those little differences and then putting everything into a bucket to get the overall stats, when we like to tell people, stay in the building as much as you possibly can, and then only go outside if you have to, right? But in this market where sales volume was down half the year in 2020, for 6 months of 2020, sales volume was down 60 plus percent.
Right.
60 plus percent. So now if you think about this in terms of price discovery for all of us people out there, agents and consumers alike, trying to figure out price action and price discovery on the Manhattan market, we have 60% less stuff to look at for comps and for pricing trends. So when you ask about price per square foot trends, this is the overall point, is now becoming circular and coming full circle here.
Correct.
I don't have a lot of data in these areas. And when we're going to one bedroom condo market in the Upper East Side, price per square foot, you're seeing bars that, like, where we used to have 30, 40, 50 sales in a bar for a month, now we have 6 or 8 or 9 or 10, fraction of what it used to. And the side effect of that is that the statistic, the sale price per square foot, or the median sale price for that period of time, is no longer representative of the entire meaty market in that sector. It's more representative of those 6, 7, or 9 properties that happen to close in that month.
That's right. The anomalies of 2020, that we're not able to as precisely provide with the price per square footage, even in the same building, because of the areas that you were talking about. Right. In terms of pricing also, and you mentioned the differences between the co-ops and the condos and the package that we need, we as agents, and also as working with our buyers, we need to make them aware, for instance, the difference between a condo and a co-op, because maybe the co-op will have a heavy debt, because they have put a new elevator, or they have put whatever it is that they have done in terms of renovations, and that might affect a person's desire to buy in that particular building.
Exactly. And you know what? Every buyer should know that ultimately their attorney is going to do a due diligence before they sign a contract. That's going to have those building financials. And, one misconception is a lot of people think that buildings operate at a profit, like they're a company. They're not supposed to act at a profit. Most buildings will operate flat, or they might even have a slight loss. And I think some people will look at a building if it has a slight loss, and they'll kind of misconstrue that building's bad and just put it in that category, where there might be reasons for that are temporary, that the building's now in the process of fixing, where in 2 years it's going to be a completely different story. That's where a good attorney comes in. But yes, every building is its own little market.
Yeah, that's part of the due diligence. So I often provide my clients with financial statements of the buildings, and especially looking at the footnotes in the financial statements, because that explains a lot as to why there is a debt. Like I said earlier, they acquire a new elevator, where they put in renovating floors, or maybe they add in a spa, or whatever it is. It needs to have some sort of justification.
It's funny, Maria. Everyone wants building with new stuff in it, but they don't want to pay for it. You know what I'm saying? So it's like, they're going to redo the elevators. Well, wait a second, I'm going to get an assessment for that? Well, I want a new elevator. Well, great, but I don't want to pay for it.
That's right.
Every single building in Manhattan will undergo major capital improvements, MCI, and ultimately so it's like, you're not going to buy a building that's immune to it. So every building has assessments. It's just a normal part of life. And you know what? The higher the building that has more units in it, the more economies of scale that you have going into it.
Exactly.
That's a factor also. You got 300 units, all divvying up, versus a small building with only 8 units in it. Different.
Right. So again, it's up to the desire of the acquisition criteria of the particular buyer. because, like you said, the larger the number of units, the more that whatever the cost is spread amongst the various owners, and therefore the lower your common charges. And also, if that particular building happens to have commercial space, let's say a garage or lower floors, I mean, that is tremendous income for the building that, again, reduces the overall common charges.
And you know something, you just kind of, not to pivot something else here, the commercial sector and the rental sector in Manhattan is doing different things in the sales market right now. Yeah. And the commercial sector's down and out, right? And it's been finding it's been hit. It's not like it's falling. The pace of decline is much slower, if not bottoming, than it was 7-8 months ago, right? So it's already happened. It's in a bad place. It's not going to like bounce up anytime soon. The rental market is similar. So flip that for opportunity, right? Let's just start thinking contrarian, right? So we're buying a Manhattan sales asset that was hit when the whole national market in the United States has been rallying, right? The whole national market.
Yeah.
Are at peaks. They're bubblicious. The dense urban markets like Manhattan's kind of hit and coming back. So number one, you're a contrarian. You're buying low. You're buying a good asset low. You're not buying it at a peak. And number two, if you buy something that has commercial space but is down and out right now, and that building is being priced accordingly, right? So you're in a building. You're buying a condo in a building, right, that has commercial space, and that commercial tenant's out, or they just got killed, they're getting hurt, they're currently in the process of actually having a bad challenge to go through. And that unit, for whatever reason, because the building dynamics are different, because they're not getting that retail revenue in to support the maintenance, is being traded a little undervalue because of this temporary situation. And when you look forward 2, 3, 4 years, chances are high they'll probably get that retail tenant back in, and et cetera, et cetera. But now's a moment in time. So contrarian, you can look for that opportunity somewhere.
Absolutely. I think that and that contrarian opportunity is not only available in the residential market, but even much more profound in the commercial market, because that is really an area that is taking a little longer to recover because of COVID. Most everybody's working from home, right? So large law offices that used to have 2 floors, they now don't need 2 floors. They're only needing 1 floor, and they're having to renegotiate those leases. And of course, the owners would prefer to renegotiate those than to actually lose that particular client, because they know that eventually things will normalize. So we were doing, like you were saying, not to get out of the particular subject matter, but I was doing another conversation about commercial space, and the attorney that I was talking to, Lynn Figman, she said, this is a great time to be in the commercial space, because you could negotiate good rates. And if you're buying actually a commercial space, this is a time maybe where you could get a lower price and upgrade it, put some money into it, so that you could automate it, and
there's opportunity in that distressed commercial sector for sure. I mean, I don't know. You got to get that information. You got to find out where it is, because those guys don't really advertise this. They they
are specialized. Yeah. So
but I mean, you're right. There's really good opportunity in those distressed commercial spaces. And you know what? I mean, the commercial sector and the rental markets they're undergoing deflationary forces that are slightly more powerful than the residential forces that are the deflationary forces that are hitting the sales market, residential. So, I think residential kind of popped through its little thing. And
I mean, somebody needs a place to live, right? So
but like when you think about down the road, Maria, and you think about like the inflationary or I should say the reflationary policies that governments and central banks are taking all over the world. I look at New York City and I think about where we're going to be in 23, 24, 25. Just think for a second. The great financial crisis in 2008, 2009 was the last deflationary wave we had. And the Fed and central bank provided liquidity and printed money and did all that to the tune of about $1 trillion, something along those lines, to rescue the mortgage-backed security market. So this is now the everything kind of bubble kind of thing due to the pandemic. The response, the stimulus response has been, magnitudes greater, 7, 8, 9 times greater than that. So think about what Manhattan did in 2010 to 2011 to 2012 to 2013 to 2014 to 2015, right? We steadily had that inflationary kind of rise to peak of 2015. When I look ahead at the 2020s, Maria, and I think about down the road, and again, this is a longer term perspective to get out of the moment in time that we're here right now, because nobody wants to buy a depreciating asset or a falling knife, even though it's fallen already. They're just kind of picking it up. 2023, 24, 25, 26, 27, we could have some inflationary episodes here.
No, I agree. And, I mean, New York City, when New York City comes back with all that it makes New York City a wonderful city to live in, the theater and the museums and just the vibrant life that New York City has, I think that we do have we're looking forward to that bright future indeed.
Yeah, that's right, Maria. Yeah, we got tentacles, and we're kind of only working at 40% capacity for the buyer pool in Manhattan. Once all those come online, I think the market will be at a different place.
Right. So I think that we're moving in the right direction. I think that the number, is taking, like in 2020, I had an experience where things were taking 4 months plus to actually sell because of, number one, the seller was hoping that things are going to recover sooner. We never really expected that COVID was going to last this long. And of course, the buyer was saying, no, this is the time, you have to negotiate. They have a number of bids out there. So we're beginning to see now a little bit normalization, right? So instead of 120 days, maybe we're going to be looking a little less. What do you think in terms of
I've been
what
talking
it takes to sell?
Yeah, Maria, I've been talking on my weekly report that we put out on Friday evenings. The days on market number I'm not too big of a fan of, because we did have the shutdown, the pause of days on market for 90 days back in the COVID period, the COVID era. Right. And we're about 75%, I would say, if I had to estimate, phase that out. Like, we're close to getting that out. So what happened was days on market before this whole thing started was around 110, 115 or something. Right. And ultimately, during the COVID crisis, a lot of things that went into contract did not have days on market ticker going. It was paused. Yes. So all of those, for a period of many months, all of those contracts that went in that powers the days on market statistic, right? Because it's a contract sign based measure, right? How long did it take you to get the contract? We're all 0 to 90 days lower than they really should have been. So what happened is, the effect it had is days on market went from 115 before the crisis straight down to 60 at around June, July, which, as a market signal, when you see days on market falling that fast, you think the market's strong, you think there's euphoria out there, and you think things are flying off the shelves, when in reality, the exact opposite happened, and we had a shutdown and things were not flying off the shelf. So again, days on market was kind of rigged for COVID, and it had an effect from 115 down to 60, and now it's at 90. So now it's like coming right back. So it's literally fell and it's going right back. And that's exactly what should happen in a rigging situation, is it has its effect, and now the effect is being phased out over time, because as time goes on, the contracts that are going into contract to feed the days on market number are less and less influenced by that rigging that happened 5 months ago. So we have about another month.
Yeah, and for many, many reasons. Like, I had a client who actually was supposed to close like in May, but she was an elderly person. So she was sort of protected by, you cannot really, first, she didn't know how to do things online, and second, she didn't want to go out. So we kept postponing the actual closing until such time that, there was some final negotiations that took place. So everything is unique,
If I had to give you a number of where I think days on market is right now, so people can have a general idea, again, I think we were at about 110 before COVID. It went down to 60. That was false. It probably in reality went down to 100 is probably what it did. It probably went from 110 to 100. Right. And now it's probably at around 100. And it says 90, but it's on its way up to that 100 level. So I think days on market's around the 100 level, which is high. Right. Which is high. It is
relatively high. Yeah, still, but we're still in that recovery period, and we're
still in the recovery period. But that's a good over 3 months or something like that. So that's exactly.
So we're still in the buyer's market, correct?
Well, you know what? Right now, at this specific moment, we're in neutral, because if you think about a buyer's and seller's market, we no longer have a line threshold that says buyers and sellers market. So you wake up one day and you cross the threshold, and now it's a seller's market. We added a neutral zone in between. So we're actually in the neutral territory. So like, buyers have been losing leverage. Buyers have been losing leverage since November, late October to November. And when you look at the pulse I like to call it the pulse of the
Right.
market. The inventory, like, over the last 3 months, inventory is down around 2,400 units. And over the last couple months, pending sales is up about 1,000 units or whatever it is. So demand is going up, supply is going down. The market's been kind of figuring out what the hell's going on from this abnormal 2020 season. And we're entering a new season from a very different place, from a very strong market. So like if I was a buyer out there, here's how I would explain it. Okay. You had a massive amount of leverage, right? In March, April, May, June, July, and August. Massive, right?
Absolutely.
That started to go up around August, September. It started to eke up. And then October, November, December, and into January, it just kind of went up, meaning you're losing your leverage. Buyers are losing their leverage in real time.
Yeah. So even though we're in if you're looking at it from the buyer's perspective, it's still a good time to buy because we're still in that neutral zone, so that we could negotiate still, I mean, on average, the original, so the buyers are paying relatively maybe like around 23% of the ask right now. So if you're looking at $1 million property, you're actually closing on maybe 930. Is that?
Yeah, it's about 7%. Yeah, 93% is kind of what sellers are getting if they're asking. 7 to 10% is what you're looking in terms of negotiability under 2 to 3 million.
Right. So you could get a reasonably good discount. So if you flip that coin, and what about the sellers? What do you recommend sellers to do?
Well, I mean, the market is what the market is, right? The market does what the market wants to do when the market wants to do it. And at the end of the day, it's all about the bids. It's all about the buyers. It's all about the bids. Nothing else matters. So like, if you understand that, the best thing you could really do is take a look at a couple of things. Number one, look in your building, okay, and just see if there's anything reasonable that or similar that's sold in the last year or two, knowing that the market's down 7 to 10% from this whole COVID thing, right? So if you see a comparable at 1.2, right, maybe you're at just over $1 million or something. I don't know. You know what I'm saying? Like, you got to think about that. Okay. And secondly, you got to look at your active competition and your in contracts, because there's not a lot of closed comps to look at as a seller. Everyone likes to look at comps, show me comps. Well, deal volume is down 50, 60%. We don't have the comps that you're looking for. So you got to look at what your active competition. If I'm a buyer and I'm going to buy your place and you're a 2-bedroom, 2-bath on the 10th floor in a Chelsea condo, what are the other 2-bedroom, 2-bath Chelsea condos that are around the 10th floor? And how do you compare to those? Like, what are the other 15, 20 places? How are they priced? Because in a changing market, right, those comps are fewer and far between, like they are now. And they're also less conclusive in terms of where you're going to trade based on where the active market is right now. Right? Yes, your building is different. Yes, you're going to get different premiums, or either more or less based on your building, if it's better or worse. But if you're asking 1.2 million, okay, I don't care how good your building is. If the active competition has 15 places for $995 or less, how are you going to get 1.2 million when there's so many options that are less? That's what I'm saying. So you have to keep track of where the active market is.
Yeah, because we have there's so much data out there that most buyers have already all that information, right?
Yeah, they know.
Yeah, even though we were saying we don't have complete picture of all the data to do an actual analysis, because 2020 was such an anomaly, nonetheless, there is data there. And certainly, as you stated at the very beginning, start with your building, because that's the real comparable that you have.
Yes.
So I know we don't have.
I'll give you a couple of tips for sellers. Number one, 4 weeks, you should consider a price reduction. If you don't have a deal in 4 weeks' time, you should really figure out what's wrong. And chances are your price is probably a little incorrect. So that's enough time for the market to see what's going on. Number two, don't be scared of a price reduction. Most listings go through 1 or 2 price reductions before you go to contract, right? It's not like a stigma thing. It's what the market does to adapt, right? So like, a lot of sellers are scared. If I lower my price, I'm going to start the ball. You should have that whole strategy planned out before you even list. Yeah. Right. You should list at a price where if you don't get it in 4 weeks, you're very comfortable to do a pricing reduction and go to the next level. Like, there should be a whole strategy there. And number three, just to let you know, guys, if there hasn't been 15 or 20 people in your place within a 4 or 5 week period of time, that's a good indication that your price is really not where it should be. Like, you got to look at the traffic. The market will tell you if your price is correct.
Exactly. And I think perhaps here we could encourage agents out there to just not be afraid of providing relevant information to enable your client to be able to make that decision, because oftentimes the agent is concerned that they're going to maybe losing that opportunity to work with that particular seller, but it is our job to educate. So I think thank you for bringing that point. Yeah. I know, Noah, that timing is an essence for you and for all of us, really. What do you think is going to take to New York City to come back again? How long do you think of a period?
Well, again, I think New York City might do different things in the national market, right? So I think if the national market has a little bit of a slowdown, I wouldn't be surprised if New York City comes out of its little downturn at the same time. I do think 2021 is going to be a tough year, because I don't think we're going anywhere until commercial and the rental market stabilizes. And I think there's some deflationary forces there we got to work through. I'm worried about, look, this is a Wall Street city. I'm worried about the stock market. I think we're in this weird central bank Fed fueled melt up. And I think at the end of the day, there's going to be a correction there that might hit the New York City markets. It did not happen yet, but if it does happen, it might temporarily put us on pause. It just happens each time. But I think 2021 might be a little challenging with the after effects of the COVID deflationary forces, plus maybe a rough stock market. But looking ahead, I'm quite bullish, because again, this is a market that's already priced in, right? It's priced in on the downside. It's gotten hit. It's went through its forces. It's did its thing. It's adapted, and it's now coming back. If you see commercial and residential rentals start to come back, that will fuel the sales market to come back. And 22, 23, 24, 25, 26, again, I see a steadily rising inflationary wave that will be multiple years. It's not going to be it'll be a year after year thing. And I think the government's going to let it happen to get everyone back in a better place after this pandemic.
Oh, yeah, absolutely. We certainly need that. Absolutely. Yeah. Thank you. Let me just finalize our conversation for one question that I know maybe you may not be prepared for that, but if you have not chosen real estate, what would you have chosen? What other career would you have chosen?
Career path. I'm a trader. So, I would have loved to be on a trader desk.
Continue to be in trading.
You know what I've always wanted to be, Maria? I want to be an offensive coordinator of a professional sports team, either a collegiate sports team or a high school sports team, or some type of well-organized sports team, an offensive coordinator calling football plays for a sports team, a very well-organized sports team.
That would be a lot of fun. And so I imagine then you're going to be watching the Super Bowl this Sunday, right?
Yes. I'm a Jets fan, and I've this bald head did not get here by itself. The Jets have brought me here. So, but we had a good future ahead. So.
Well, thank you so much. Thank you for being part of us today. Thank you, the audience, for tuning in with us. Noah and myself, Maria Ellis. To learn more about our work, go to financiallegacy.live. Here, the Financial Legacy Podcast, we're changing lives one person at a time to help you create and enjoy financial success. Connect with us at financiallegacy.com for a complimentary consultation. Thanks again, Noah. Be well. Have fun.
Bye, everyone. Bye. Thank you, Maria.
My pleasure.
All right.
I'm going to run off, okay? But thank you. I really
nice to meet you, Noah.
Thanks to meet you, Christy. Bye-bye.
Bye.
Cool.
Okay.
How did it go?
Another one in the can. It sounded really good. He was great. Very dynamic.
Yeah, he's a fun speaker.
Yeah.
Okay, darling, I'll send you this subscription and the title.
Okay.
Thank you.
Awesome. You are so welcome. See you later.